Hi everyone, this is Varnam, Assistant Professor of MBA Department of SNS College of Technology. So friends, in today's session we are going to see a certain concept under financial management. So before entering into today's session, I want you guys to guess what the topic which we are going to discuss in today's session. Which fuels the business growth. Every successful company needs this to expand, to innovate and to thrive. So what is all about it? So what the topic which we are going to discuss? Yes, the topic which we are going to discuss in today's session is sources of finance. So before starting with today's topic, we shall have a small empathize about the topic. So here the problem is all the business will have some struggle in order to mobilize their finance. So if it is at the time of an introduction, or at the time of their growth stage, or at the time of their regular process, in some cases the company might have difficulties to mobilize their money. So obviously the company should have some sources in order to mobilize the money. So that is what the topic which we are going to see in today's session. So pain points here is the company should not the company might have some confusion about the funding option, and they will also have some fear of losing their control. And the third pain point is uncertainty about the repayment capacity. So now we will see what sort of solution can be provided to the company to overcome this problem. So the problem is finance, raising their funds. So what sort of funding options the company have in order to overcome from their problem. So that is what we are going to discuss. So the one thing which the company should always think on it is access stage, that is the company should go for matching the fund according to their business maturity, and the company should always have evaluate the risk of the sources which is available in the market. The company should not go for excess of debt, or they should not go for excess of selling the shares also. So that they have to keep in their mind. And the other point is they should have a proper strategy that should create some roadmap for them in order to proceed with their funding requirements. So this is what the first and foremost thing which the company has to have a clear idea. So what are sources of funds? So when we talk about the sources of funds, we have n options: short term sources of funds, long term sources of funds. So short term in the sense, if the company is requiring the money for a shorter period, say for example, if the company is requiring money for 1 month, 2 months, 6 months, or before 1 year, the company can repay the money. That is what called as a short term sources of finance. So when we talk about the long term sources of finance, so company require the money for longer period, that is 5 years, 10 years, 20 years, 30 years. So that is what called as a long term sources of finance. So obviously in order to meet out the working capital requirement, the company will go for a short term finance. But then in order to go for growth aspects, or in order to acquire, or for developing the infrastructure, the company will go for a long term sources of finance. So we have many funding options or sources. We will see about 3 primary funding sources in today's session. The first one is retained earnings, that is reinvesting their own profit, that is what retained earnings. Debt capital, that means borrowing the money, and equity capital in the sense ownership exchange for investors funding. So these are the primary funding sources. We will see one by one what is all about it. Retained earnings. In this case, the company will not distribute their profit to their shareholders. So what they do is they will reserve the money, they will retain the money. So certain percentage will be distributed to their shareholders. So the company will retain certain percentage in order to meet out their future expenses. So what the company will do is, whatever the company has retained, that amount will be reinvested in any new projects or new infra or their any new ventures also. So that option is what called as a retained earnings. So when the company is having a retained earnings, the main advantage is they do not go for depending on the external party to mobilize the money. They will be in the safer hand, and also they do not wanted to spend the money for mobilizing. So this is the advantage of the retained earnings. And the second option the company which have is debt capital. Debt in the sense borrowed money. So always when the company is borrowing the money, the risk will increase. That means the company might borrow a private debt, or the company might borrow public debt also. So when the company is borrowing the money from outsiders, obviously they are in a situation to repay their debt, as well as till their repayment they have to pay interest for the money which they have borrowed. So this is a huge risk for a company. So when they have been thinking this option, what they have to do is they should not go for borrowing excess of money or huge amount of money, because if the company is not able to repay the money to their debenture holders or to the financial institutions, obviously they might get insolvent. So here the company should always have an option of getting the money with limited risk. And the third option the company might have is equity capital, that is ownership exchange. The company can go for mobilizing the money from the shareholders through stock market, where they can sell the shares, and public are open to purchase the shares. So that is one option. Or the company might go for approaching venture capitalist firms or private equity firms in order to mobilize. So when we talk about the equity capital, the company should always go for less amount of mobilizing through equity. The reason is, if the company is going for higher amount of equity capital, their ownership will get diluted. So they should always be have keen enough in raising the money in through equity capital. They should not lose their control, so that the ownership will be stay in the company's hand. So students, in today's session we have seen what is sources of finance, and we have seen three options. One is retained earnings, the other one is debt funds, the other one is an equity funds. We have seen the pros and as well as cons of mobilizing the each instruments. So hope like you all would have understood with today's session. Meet you all in the next session. Thank you for listening the video.